The following is a paid commercial program. Unless otherwise identified, the guests on the program are employees of or otherwise represent the advertiser. The opinions expressed therein are those of the advertiser and do not necessarily reflect the views and policies of 640 Toronto.
And good Sunday morning to everyone out there. Thank you so much for making us part of your weekend, and happy Father's Day to all the dads out there. We appreciate your time as well. And, I think that a lot of what happens between fathers and their children, advice gets handed down, advice gets passed on. Sometimes it's about money. And, our show is about your life and your money. And the guy that we go to for our money advice is Kelvin, the money guy, who's a father himself.
Yeah, boy, what a week or month has been for the markets, right? I tell you, it's been one of those that we haven't had to deal with this for quite a while. I mean, when we look at what's going on with our money and just the world in general, it's one of those things that I guess every so often happens, and we got to kind of manage through it. And if we do so, we'll be okay, right?
Yeah, exactly. And I think that that's really what it comes down to, is making sure that you know what to do and where to be putting, whether it's your investments, your money, your retirement, how to navigate all of this to make sure that you come out on top. That's all it comes down to.
Yeah. So the question is how and what to invest in a recession. And most people that are listening didn't really have to deal with a recession. The last one was in 2007 to 2009. And before that was 2000 and so on. So what is a recession? What do you think a recession is?
I do remember, from my high school economics, I think a recession is like 2 quarters of negative growth. Is that if negative growth is a thing? Yeah.
Yeah. So a recession refers to a period of declining GDP, and it's generally defined and sustained decline for 2 or more consecutive quarters. So we're already in the second quarter, and we know for sure, we're already in a recession, right? Because we know already that it's negative growth. But, recessions aren't just about poor economic growth, right? They're often accompanied by several other characteristics. For example, like widespread job losses, fewer available jobs and more government relief. Like think of stimulus and increased unemployment benefits. Mm-hmm. So with all that in mind, people are wondering if investing is a good idea when we're in a recession, or are we heading in that direction, or is it wise to take every dollar you make and keep it in cash? So what do we do?
Well, right? That's the thing. You find yourself in a position where the intention of the central bank seemed to be they're raising interest rates. Maybe they want us to save our money. They want us to keep it and hold on to it, and we're not able to. Borrowing power isn't necessarily there, but we've got inflation at a level where everything costs so much as well.
Mm-hmm. So is it safe to invest during a recession? So the answer is up to you, I guess. During a recession, stock values decline, as we've seen over the last few weeks, right? So in theory, that's really bad news for existing portfolios, right? So leaving investments alone, not locking in recession-related losses. So leave your money alone. What's more, lower stock values offer solid opportunity, meaning that stocks are relatively cheap. So if you got some money, put it in. If you don't, just sit back, right? Investing during a recession could be a good idea, but only under circumstances, like under certain circumstances depending on you. So one thing we find during a recession is make sure you have plenty of emergency savings. For example, make sure you have like 6 months living expenses. So if you have extra cash, keep it. if you don't have the cash, maybe have a line of credit ready to roll in case you lose your job or something was to happen. So I think that's the very first thing people need to do is make sure you have plenty of emergency savings, because like we say, during a recession, there's layoffs and job losses and things like that. And if you're unfortunate to do that, to have that, then yeah. But before I get into this, let me just update what the marks have done so far. So I don't know if you're going to plug your ears or listen more. But but the Dow is down 17%. The S&P is down 23%. The Nasdaq is down 31%, and the TSX is down about 8%. So what does all that mean? Well, all that means is don't look at your statements. Go about your business, because things will happen. So if you're another thing during a recession is you're not planning to touch your portfolio for at least 5 to 7 years. Okay, so when you're investing your money investing during a recession is not for the faint of heart, right? You may think about buying low, only to see your portfolio go down again the next day. You might think, "Oh my God, it went down again."
Right. So it's almost like we're feeling for the bottom a little bit. Yeah. Like you gone into the pool and you're feeling for the bottom.
Right.
And, you're thinking, I'm going to buy on the lows. I'm going to try and make some money on the way up. But,
and you don't know, right?
You may be on the way down still.
Yeah. So the best way to avoid losses in a recession and come out ahead is to take a long-term approach to investing. Plan on leaving your money for 5 to 7 years. So, I just gave you the numbers for the Dow from January to now, right? So I went back 5 years, taking my own advice, 5 to 7 years, and I looked back to 2017, June of 2017. The Dow Jones was at 21,394. Today, it's at 29,888. So what does that mean? It means from 5 years ago today, you're up 39%.
Wow.
Similarly, with the S&P, back June 2017, it was 24.38. Today is 36.74. What does that mean in real money? You're up 50.5% over the last 5 years. Similarly, for the Nasdaq, you're up 72% from June 2017 to June 2022. So what does really 6 months have to do with anything? Nothing. So that's why I say when you invest your money, don't plan to touch your portfolio for 5 to 7 years. Maybe tweak it a bit, but don't sell anything. Don't do nothing.
I think that's really important perspective to take a look at the way that the markets work and to see exactly with a long view of the road ahead or the road behind as well, where we've come from and where we're going. And I think there's a tendency in a lot of people who are investing to, watch their windshield. They're driving, looking at maybe just the nose of the car. They're not looking at the road ahead. And if you do that, you don't know what kind of course corrections you need to make. You need to take a broad view. Speaking of Father's Day, I remember my dad saying, look at the road ahead. Don't just look at the end of the nose of the car here, son. You got to keep an eye out on what's happening many, many car lengths ahead. And if you do that, you've got a long approach and you know that you're going to get to your destination. Whereas if you're staring at the nose, if you're staring at your portfolio and you're looking at your statements constantly, everything's going to look like the sky is falling.
Yeah, it's like when we first learned to ride a bike. You're right. We tend to look down, but we have to look straight ahead, right? You're right. You're exactly right. So the one thing is that you're going to do during a recession is you're not going to obviously check your portfolio. When the economy is in bad shape and there's a lot of stock market movement, you may be more inclined to log into your account every day, right? So maybe after the break, we'll go into why you don't want to do those things.
Perfect.
Go against what you think.
Awesome. Always appreciated sage advice from Kelvin, the money guy, and that continues as your money continues here. Don't forget to visit Kelvin's website, askkelvin.ca, askkelvin.ca, or you can call him anytime at 416-457-7526. That's 416-457-PLAN, askkelvin.ca. Stay tuned for more of Your Life, Your Money right here at 640 Toronto.
You're listening to a paid commercial program. Unless otherwise identified, guests on the program are employees of or otherwise represent the advertiser. The opinions expressed therein are those of the advertiser and do not necessarily reflect the views and policies of 640 Toronto.
And welcome back to Your Life, Your Money here at 640 Toronto. My name is Chreston. I am the radio guy, but we're joined by the money guy. That's the guy that you want to hear from. That's Kelvin, the money guy. You can always visit his website, askkelvin.ca. That's askkelvin.ca. Or you can give him a ring anytime, 416-457-7526. That's 416-457-PLAN. Or you've got a question about your money life in general, please feel free to give us a ring. You know, we're going into some uncertain times, looking at recession, thinking, how do I make sure that my portfolio is ready? How do I make sure that my investments are right? Do I lock in on something? Am I looking at GICs? Am I looking at making tweaks along the road? And, just before we took the break, we were talking about checking up on your statements on a daily basis, logging in and seeing where you're at, and trying to navigate with every single bump in the road. And Kelvin, I think where we left off, we're going to talk about why that's a bad idea.
Well, the one thing you said was GICs. That's the one thing you don't want, because inflation in the U.S. is at 8.6%, and GIC is about maybe 2%. So you're actually losing more money in a GIC.
I said that because I know it's a bad idea.
Yeah.
I said that because I know from experience, from my own personal mistakes, that when the market goes down and you're in a recession, don't lock in. Ask your old friend Chris.
Yeah, exactly.
That is a good way to lose your money.
Yeah. So the one thing you want to do in a recession is you're not going to obviously check your portfolio. Please don't do that. You're more inclined to log into your account every day and see how you're doing, because you listen to all these reports. But if you're going to invest during a recession, you can't do that. The more you check up on your statements, the more likely you're to panic. And when you panic, you risk making rash decisions, such as, unloading poor performing stocks, and force yourself into a loss, which you'll never, ever, ever make back, right? So it can be a great idea to invest during a recession, but it's only if you have a strong enough financial position to do so, and only if you have the right attitude and approach. Remember, your feelings, get rid of your feelings. You don't have any feelings when it comes to recession and money. Don't compromise your near-term financial securities for the long-term gains. Remember that if you're hurting financially, there's no shame in missing out on opportunities. Don't worry about it, right? Instead, focus on paying off your bills, staying physically and actually mentally healthy, which is a big thing that we don't talk about. You can always ramp up your investments at a later point in your life. Once your job is secure, your earnings are steady, and your mind is at ease. So think about yourself personally before, when these recession things happen. Don't just look at the markets, because like I said, the 5-year term, if you go back 5 years into your money, it's done really, really well. Go back 10 years, same thing. So manage your money like pension, like the way they manage the CPP. People that have defined benefit plans, if you're lucky to have one, you don't worry about that because it's out of your control. So think of your RSPs and your TFSAs the same way. Real world results of investing in recessions. Long-term investors who put their money to work during a recession have done pretty well over time, right? The 3 recent recessions prior to COVID was the Great Recession from 2007 to 2009. Remember the financial crisis? How we forget about that.
That's
right?
How I learned my GIC lesson.
Right, exactly. The recession in 2001 was fueled by what? What do you think?
9/11.
The dot-com crash and the 9/11 attack, right? And the 1990 and 1991 recession that followed a long economic expansion in the 80s. So you might be surprised at the long-term results, even if investors timing wasn't perfect. Remember, you can't time the market. They say that there's 10 best days in the markets. Now, which are those best 10 days? Well, I don't know. So the idea is to just stay invested, and you'll get one of those. If you miss those days, it makes a huge difference in the return that you get. So if you invest at the market's lowest point during a recession, you're only going to do quite well over time. But one thing investors should realize that trying to time the market is always a losing battle. You'll never win. I don't know anyone. I've been doing this for a long time, and I don't know anyone that has won. So there's no crystal ball that can tell you when the markets are at its bottom. So in other words, you're not going to invest at the absolute perfect time. So if you're thinking of doing that, it ain't happening, right?
So if you stay invested, you've got your money in the market. Maybe you're not throwing any extra money at it. Maybe you're not,
right.
Chasing some get-rich-quick scheme, but you're just riding the wave. You're going to hit those 10 best days of the year. You're going to hit those 10 days that are going to make the best gain for you because your money's already in there.
Yeah, well, think about it. Even if you had invested in the S&P 500, right, which is a real measure of our money, at the worst possible moment in 2007, right? The markets peaked before that was the market peak before the financial crisis in 2007, right? So if you did that, you would achieve about an 8% return over those 13 years. So that's not bad. It means you're doubling your money in like 10 years or so. So if you bought at the heights before the 1991 recession, you would have achieved about a 9.8% annualized over those 30 years. So, the lesson we have to learn here is sit tight. Consider what this means when in 1990, 1991, and the 2009 crisis, right? If you invested $10,000 in the S&P at the worst possible time during 1990 and 1991 recession, today your investment would be worth $150,000, right? Assuming dividends, were reinvested and the normal things that you're supposed to do. So you put in $10,000 in 1990, 1991, and it's worth $150,000. Now, along those 30 years, lots of bumps along the way, right? A lot of stuff happened. So, we need to stay involved and engaged. These are the times where you really need your financial advisor to handhold you through all of this maze of ups and downs, right?
I think that's so important is, to make sure that you've got sort of that steady hand of a financial advisor, because we can get our emotions involved so much, and it's impossible to not. Your whole future and your hopes and your dreams are tied up in your investment, so you get emotional about it, you get scared, you get excited, you get all kinds of things. But if you've got a financial advisor there, you've got someone to sort of walk you back from the ledge and help you make the right decisions. And it's one thing to be sort of impartial and objective, but it's another thing to have had the experience of decades and seen the ups and downs and to understand exactly what to do. And that's what you get when you get Kelvin, the money guy. If you've got an advisor, give your advisor a call. But if you want a second opinion or you don't have an advisor, call Kelvin, 416-457-7526. That's 416-457-PLAN, or you can always visit Kelvin's website, askkelvin.ca, ask KELVIN.ca. We'll take a break in a couple of minutes here, Kelvin, but I just wanted to sort of thinking about where we've just been. It's been one of the longest bull markets, if not the longest bull market in history, and we find ourselves doing pretty well. And then you get the central banks worried about inflation, putting up interest rates to try and calm that down. They probably see a recession on the horizon here. If we know there's a recession, if Elon Musk knows there's a recession, then the central bankers probably know there's a recession too. So they're likely to be planning to lower those same interest rates again soon to try to juice the economy once it starts to slow down.
And you're right, and I think exactly that's gonna. You know what a meltdown is, right? A meltdown with the nuclear thing and all that stuff. I think we're heading into a melt up, in the sense that you're right. I think if the price of oil goes down over the next little while, the reverse of what's happening now will happen. Interest rates will come back down. I think if the supply chain and all the stuff that we listen to in the news goes away, it will come back. It'll settle back down. But we have to. It has to get bad before it gets worse, like everything else. So maybe so after the break, we'll talk about what to invest in during a recession. So what do we invest in during the recession? We know the recession is here, so we can't not say, "Oh, I don't think it's coming." Well, I don't know if it's coming. Well, we know it's here, right? So plan for the things. Plan for that stuff, right?
So what we should be looking for and what we should be thinking about putting our money into during the recession. You've decided, I'm in a good position to make some investments during this recession. I can capitalize on some of the losses that are happening. I can find the right kinds of stocks or companies that to put my money into. What are those, and what should we be doing with our money to make sure that we come out of the recession in the best possible place? That's coming up on Your Life, Your Money. Don't forget, you can always call us, or you can always visit Kelvin's website. That's askkelvin.ca. That's askkelvin.ca. And you know what? You go onto that website and you can click the schedule a call link up in the top right hand corner. You click on there and you go and you pick a time and date of your choosing, so you don't have to play telephone tag trying to get a hold of Kelvin. You book that time and date, you've got your call booked, and you can chat with Kelvin privately about your finances and about the situation that you find yourself in. Maybe you've got something that you want to talk about that's a little delicate. Maybe you're trying to balance what your portfolio should look like going into recession. Visit askkelvin.ca and schedule a call with them by clicking on that link. Schedule a call, book a time and date of your choosing. That's askkelvin.ca. A whole lot more of Your Life, Your Money with Kelvin the Money Guy coming up on 640 Toronto.
You're listening to a paid commercial program. Unless otherwise identified, guests on the program are employees of or otherwise represent the advertiser. The opinions expressed therein are those of the advertiser and do not necessarily reflect the views and policies of 640 Toronto.
And welcome back to Your Life, Your Money. I am Chreston, just a guy on the radio, but we're joined by the Money Guy. We're joined by one of the top financial advisors in the country. His name is Kelvin, the Money Guy. askkelvin.ca is his website. That's askkelvin.ca. And you can give him a ring anytime at 416-457-7526. That's 416-457-PLAN. And we've been talking about investing in a recession because we're here. And that's the situation. This is what we're doing today. And there's nothing that we can do to change that. But what we can do is make sure that we're set up to find ourselves on the winning end of this recession on the other side. And how do we do that? We make sure we've been through a few things. We don't look at our statements every single day and freak out and make rash decisions, locking things in for too long, selling things when they still have room to grow or anything like that. You want to make sure that if you're in the market, you're in it for the long haul and you're not trying to time it day to day. And one of the other things that we're going to talk about here is what you should be doing with your money. So you've decided that you're going to be putting your money into the market. You've decided you're going to be doing some investments. What should you be investing in? What kind of tools and products should we be looking at in this situation?
Yeah, so many people prefer to invest in individual stocks, and I think that's going to become a problem for a lot of people because they don't know what to buy. Right, the best investment strategy in any environment is to find good businesses and hold on to them as long as they remain good businesses. Right. But this focus on quality is especially important during a recession. So the thing is, if you're invested in individual stocks and you're a do-it-yourselfer, well, how do you know the business is good? How do you know their balance sheet? You don't. So maybe this is the time to seek out an advisor, talk to your advisor, and maybe get a a nice, well-balanced portfolio for yourself. When things get back good again, yeah, go do it on your own. But right now, you need the hand-holding. Take the pandemic. That's our recent, remember, I think, right? The COVID. And some of the subsequent recessions. Companies in affected industries that had stronger balance sheets going into the crisis had an advantage over those that didn't. Look at all the people that went broke over the pandemic. But companies that were solid got even better and made even more money. So companies with financial flexibility to survive these long disruptions, they look like they're excellent for long-term investment opportunities. And long-term, we talk about it all the time. Like, how long is long-term? I say you got to look at 5 to 7 years, and that's your long-term. Now, longer is better, but that should be your start. 5 to 7 years. If you're going to take your money out before that, I don't know, spend it, man, because you go through too much bumps, right? So look for good businesses, low liquidity stuff during the recession was hardest hit. So people that didn't have money, companies didn't survive. So in a recession, how you invest can be just as important as what you invest in, right? In a recession, in recessions, I guess, stocks tend to be rather volatile, as we just saw in the last week, actually. And as anyone who was involved in the markets in 2008 and 2009 financial crisis can tell you, you saw like a 50% drop in your money. Fast forward today, and most people have doubled their money, if not tripled, right? So rather than trying to time the market, maybe if you have some money, maybe you want a dollar cost average. And maybe if you got some money, you want to buy some today, buy some next week, I don't know, something like that. So these kind of investments, dollar cost averaging, is really great on certain times, right? When we're like this, we don't know one day to the next what's happening. So again, that's why it's important. I think people sit down with their advisor and make some decisions. We know we're going to come out of this. It might be a temporary recession. It might be a prolonged. We don't know. But get ready for those kind of things. Right now, everything is cheap. Like, everything has gone way down. Like I said in the beginning of the show, most stock markets are down 15%. So you're buying stuff 15% lower. Grab your portfolio and see where you are. One thing I think that's going to freak out a lot of people is when they get their statement in July. Because what happens is you're gonna look at your $1,000 and it's gonna be worth like 90. And go, oh my God, what's happening, right? So you need to get ready for those things. So I guess in a nutshell, a recession can be a great time to buy the stocks of a top-notch business at a favorable price. Think of Netflix. Think of all the FANG stocks, Alphabet, all that kind of stuff. What's going on? So these recessionary times, depending how you look at it, are good times, right? Remember, my first thing was to make sure you have plenty of emergency savings somewhere, just in case, you get laid off or, a company, whatever may happen, right? So emergency cash is really important to get you through all the big, stress, right? So if you don't have the money and you're fortunate to have a home that has some equity, maybe take a line of credit and hang on to it just for old time's sake, right?
Well, and I think that's important to have that sort of emergency cushion. Otherwise, you're more likely to panic, right? You're more likely to panic if you've got less wiggle room. And it's easy to say, but maybe if there's a way to make sure that you put a little bit of money aside for savings, and you're going to be okay, and you're not going to panic. I know it's been said often about the stock market: if you're going to panic first. Well, the people who panic first already panicked. We missed that train. It happened, and now it's up to us to make sure that we make the right, logical, objective decisions, and that's why it's so important to have an advisor.
And I think so. Look at some of we're looking in the news now. We've seen some companies that are, invest with robo-advisor are laying off people. because the average investor now is seeking out an individual, a human being, an advisor, whoever they are. Now is the time to find one. Like I always say, if you have one, deal with them. If you don't have one, call me, because you need some hand holding now. Like I said, when the markets get back better and everything is going great, maybe you don't need us. But I think right now you need to seek out the advisor and take advantage of what's happening. So we talk about what to invest in during a recession. Well, we should talk about what we'll talk about after the break is what not to invest in during a recession. Right?
Always important to think of that. Think of where you should stay away from. Those are the dark corners and the scary places in the market that you might not want to get involved in, and we're going to touch on that as the show continues here. Don't forget to visit Kelvin's website, askkelvin.ca. That's askkelvin.ca. You can listen to past shows there. You can also schedule an appointment to chat with him and get that hand holding, get that coaching that you need in this time, get that co-pilot that you need to help make sure that you get your nose up and flying right into the recession, so we come up on the other side doing really, really well. If I could keep the plane metaphor going, I guess we'd land at some point, and I guess that's retirement, and that's and that's something that you've got to sort of keep in the long view as you continue looking at making sure you do have a long view on your investments, especially going into a recession. Visit askkelvin.ca. That's askkelvin.ca, or you can give them a ring, 416-457-7526. That's 416-457-PLAN. Stay tuned for more Your Life, Your Money right here on 640 Toronto.
You're listening to a paid commercial program. Unless otherwise identified, guests on the program are employees of or otherwise represent the advertiser. The opinions expressed therein are those of the advertiser and do not necessarily reflect the views and policies of 640 Toronto.
And thank you for making this part of your Sunday. Happy Father's Day to all the fathers out there. We appreciate your time and your ears and your attention. Please feel free to reach out to Kelvin anytime at 416-457-7526. That's 416-457-PLAN. And you can visit his website, askkelvin.ca. That's askkelvin.ca. Before the break, we were talking about what you should be investing in during a recession. And as we wind down here, we should probably be talking about what not to invest in during the recession. And that's why it's great to have someone like Kelvin around, because Kelvin, the money guy, has seen recessions before, and he knows where things go and how to best weather the storm. Kelvin, what should we be staying away from in
so what not to invest in during a recession? So a recession is a good time to avoid speculating, especially on stocks that have taken the worst beating, right? Weaker companies often go bankrupt during recessions. So it's just a leveling of the playing field. And sometimes, we see stocks that have fallen 80, 90%, or even, fallen 89%. We might think, wow, it's a great bargain. And they're usually cheap for a reason. Just remember, a broken business at an excellent price is still a broken business. So ultimately, it falls so much, you think, my God, I'm going to buy some of that. Well, you better check the company and make sure the balance sheet and that's okay, that they got money, right? So the most important thing isn't necessarily what not to invest in, but what behaviors to avoid. Remember, it's our feelings and our emotions and our behavior that make us either win or lose, not greed or fear, right? They say when people are greedy, you be fearful, and when people are fearful, you be greedy. So people are fearful now. So maybe you want to adjust your portfolio to be greedy. The one thing I can say is about your behavior, specifically, don't try to time the bottom. We always try and think, oh my God, I'm going to wait and buy and sell, and I'm going to sell today because it's so low, and I'm going to buy that. But it ain't going to work, right? As previously mentioned before, trying to time the market, it's a losing battle. Wouldn't it be great if you invested as much as you possibly could in say, March 9th of 2009 when the S&P was at its lowest level in the financial crisis. Wouldn't that be cool if you did that?
Oh, it'd be great, but how would you have timed that? How would you have known?
You wouldn't know unless you go back to the future and get that book.
Well, that's it. You know what? I was just thinking maybe an investment is a DeLorean and maybe some plutonium, and we can go back and then we'll be able to make all the right decisions. But you can only do that in the rearview mirror, right? You can't. I
know.
Until we do that, until Doc Brown comes up with the flux capacitor, we're not going to do it.
Yeah, and that's why they say the windshield is bigger than the rearview mirror. So look forward, right? So wouldn't it be nice wouldn't it be great if you knew tomorrow's lottery numbers ahead of time? Be cool.
Yeah, that'd be great.
Yeah, but nobody knows when the market's going to hit bottom. So invest in stocks or funds you want to hold on for years, even if the markets continue to fall in the near term. Like buy quality stuff and hang on to it. Like, Canadian banks, they do very well. Make sure your portfolio is loaded up with things like that. I'm not a portfolio guy. I don't know how to build portfolios. That's the furthest thing from my mind. But the one thing I do know is how to handhold people during these type of recessionary times, and how to comfort you to make sure that you don't lose all your money and you don't stress, right? Don't try to day trade. Remember those day trading people, right? These days it's easier than ever to start, trading stuff, right? Thanks to, zero commissions and stock trades and user-friendly stuff the apps that you can get and all that kind of stuff.
Well, the apps turn it into a game, right? Like it's so easy to just do.
That's right.
And you can speculate on something that you're really interested in, or you put it all into crypto or something, and you find yourself, not doing so hot.
If you want to mess around with a small amount of money that you're okay with losing, that's fine, right? Get it out of your system. But the long-term investing is a far more certain path to wealth in the stock market. Day trading as an investment strategy is really a bad idea. Remember what I say, money is like soap. The more you handle it, guess what happens?
It disappears.
Yeah, so don't be fooling around. Don't jeopardize your future, for what's going on now. It doesn't make any sense. I mean, use common sense. People don't try to do that anymore, but, and don't sell because your stock went down, right? That's another thing we do. Oh my God, it went down, so I'm going to sell everything and sit and wait. Well, that's a fool's game as well. One thing that's extremely important to avoid during a recession is panic selling when it falls. I don't know if anybody listening had called their advisor and say, oh my God, sell everything because it's down, it's going to go down even more, the world's ending, right? Well, it's human nature to avoid volatile situations. When the stock market is in free fall, like I say, you might be tempted to sell before things get any worse. So don't give in to your emotions, especially with money, right? The goal of investing is to buy low, sell high, and repeat till you're rich. That's the idea. But
I like
it. Yeah, but panic selling is the exact opposite, right?
So that could happen. You wind up getting your statement in July, say, and then you see that things aren't doing well, and you decide to sell everything. What should you be doing instead? Call your advisor or call Kelvin, and you get on the line and you figure out a way to ride the storm rather than bailing out of the boat.
Yeah, listen, Chris, listen. The bottom line is that during recessions, right, it's important to stay the course. It becomes a bit more important to focus on top quality companies in turbulent times. So look at your portfolio and see what you got. Do you have big, huge companies that do well during recessionary times, like consumer goods and so on? But for the most part, you should approach investing in a recession the same manner you would approach investing in any other time, right? Again, buy quality companies or funds and hold on to them as long as you stay that way. So remember, call your advisor, sit down, don't panic, don't time the market, don't sell, don't look at your statements, enjoy the summer. You'll be fine.
Awesome. Great advice from Kelvin, the money guy. If you want to tap into his big money brain and his years of experience, askkelvin.ca is the website. That's askkelvin.ca. Or you can give him a ring, 416-457-7526. That's 416-457-PLAN. askkelvin.ca is the website, and the number, again, 416-457-7526. Thanks again for another great show, Kelvin.
Thank you, Chris. Have a nice day.
Thank you for listening, and stay tuned to 640 Toronto.
The preceding was a paid commercial program. Unless otherwise identified, the guests on the program are employees of or otherwise represent the advertiser. The opinions expressed therein are those of the advertiser and do not necessarily reflect the views and policies of 640 Toronto.